Welcome back to the Epic Investor Podcast. I'm Rich Jarvis with Epic Capital Funds, and I have with me Jason Morris from Impact Equity Partners. And we are thrilled today to talk to you about underwriting. So you and our Succeed formula, underwriting for success. And by doing that, it's going to set you up to achieve freedom of purpose in everything that you do and knowing when and if you should take that next step. Let's dive in. There's so much to underwriting and it's fun. And we just talked about a podcast about, are you excited about a deal? And the excitement's there. And so how do you actually prove out that excitement that it's warranted, right? And give you permission to put more resources at risk to go down that road. That's really what we're talking about today is that underwriting. And first, I want to share a couple mistakes, stories of mistakes that we've all experienced in providing the right kind of data. Jason, the first one I wanted to share was we had a lender coming to the table on a project that we were really excited about, but we weren't presenting the right data to that lender. But they backed out, and it was because we weren't presenting the right information to them. And in their minds, they were thinking that we weren't doing the underwriting. It was just simply how we were presenting that material, right? I want you to think about the experience you had on your side when we were trying to figure out what the pushback was all of a sudden, because the lender went from full on board, pretty excited to, no, we're not going to do it. And it wasn't the deal. It was just the data that they were getting.
I remember sharing my excitement. I remember talking a lot about the numbers that we were reviewing, which again, were very high level, right? Here's revenue, here's EBITDA. So if I'm a business owner and I own my own plane and I've got a hangar for my plane, but I want to run that cost through the business, it would be an expense that I would add back to the bottom line, showing that I actually make more money than my P&L or tax return state because of an expense that's not related to the operations of the business.
Because we're not buying the plane or the hangar.
Right. So if I'm buying the business, well, that's not going to be an expense next year. So I'm going to take the 10 years of expenses you've had for that and I'm going to put it back. So, but those high level numbers that I put in front of a bank, and say, hey, check this out. Like, this is a sweet deal. And they ask certain questions and you go, oh, I'm not sure. Right. That's a red flag, right? Well, you should be sure you're doing the financial due diligence or the financial assessment underwriting of a company. I remember thinking to myself, I don't know exactly what you're going to want to look at. So here's everything. Just look at it. In my mind, when I think of underwriting, I think of like a room full, like a boiler room full of people that just are glued in front of a computer screen, right? Like, okay, we're going to give them numbers and they'll compute it. They'll think about it the way they want to think about it. And it's wrong, right? What happened after that was, let's have an understanding of the information you want to receive and the way you want to receive it so that I can give it to you the way you need it so that we can, have the outcome, whether that is good or bad. And I remember one of his comments was, we have a ton of businesses to underwrite. And if I'm not going to get the information the way I need it, I don't have time for this. That's a fair point. We're all busy. So
yep.
That was a great learning experience.
Someone's really excited about a project and I was like, this is a great deal. And then they throw down a napkin and it's got some scribbles on it, say, this is how much it can make. What would be your first reaction to that? Just curious.
Can I see the real financials?
Right. Oh, we haven't made that, but high level, it works. See, it works, right?
This is great blue sky talk. Great.
My role at the time was, working on the capital markets to help bring, the equity and the debt together but present the story, right? It's the story of why we think this is such a good project. Because the napkin, one way or the other, there is a place for the general or the high level numbers to make sure that those high level numbers work, right? And that gives you permission to go put more resources or energy and time, to go deeper into the project in underwriting. And I've seen pro formas that are one sheet on the spreadsheet, and I've seen some that have hundreds of sheets. With private equity and business acquisitions, we use what's called a reservoir analysis on the high level.
The idea behind the reservoir analysis is we want to identify what reservoir or what will be left over, what will be left of a net income or an EBITDA of a business. So if a business makes $10 million in revenue and through its operations, it's putting $1 million to the bottom line, I want to know, okay, if I take on an annual basis my $1 million net income and I service the debt to buy the company and I pay, a C-suite or an operator to run that business and I take a management fee, how much is left over? And I personally want to benchmark about a 20%, maybe 25% reservoir. So if I've got the bank terms the right way, if I've got my terms with an investor the right way, if I've got a seller carry note terms the right way, and I can play with those numbers all day long, right? Like there's by the way, there's a lot of excitement around the underwriting of this deal where you can play with these numbers and make sense of it, and you can use it as a negotiating tool so that when I'm done with all that, I want to see that my reservoir or what's left over is about 20 to 25% of that $1 million. It tells me immediately we're healthy. We at least can move forward because there's enough buffer there to sustain an industry trend. There's enough buffer there to have a bad month and not ruin the deal for the year. There's enough buffer there to have some working capital and maybe even some dividends in your first year.
And to me, what it does is it gives you permission at that point to put a lot more time and resources behind doing the due diligence and diving in. So it's essentially saying, this is the reason why. You're telling the story that this is a good project. It has the cash flow. The fundamentals are there. And now we can go deeper.
It's funny you bring that up. I was just on a call this morning with Richie, our analyst at Impact Equity. There's your plug, Richie. And we were looking at a deal and we were starting to talk. We both fell to this. We were starting to talk, about step 12, like what are we going to do with this person and how do they interact with the operation? And I'm like, hang on, 5 minutes into it, right? Hang on, wind it back. Let's start with the res analysis and then go from there. If the res analysis checks out, we'll have further discussion, but we're not doing anything until that comes first, right? And so to your point, Rich, and I love the word you use, permission, it gives you permission. It gives you the ability to continue to maneuver step by step. If that step makes sense, take the next one until it no longer makes sense.
So underwriting on the real estate side, it's the same thing. We want to take all of these inputs and, the inputs such as land costs and development costs and vertical costs. And we want to look at timing and then the market trends of where are the current rents or how much is a unit like that worth per square foot? And does it make sense to build that? Or are we trying to do something different than what the market, all of those things have to be, shared, right? The best resource I have ever found for institutional level quality on underwriting spreadsheets is by a man named Justin Kivel. And so what we do is we just have a new analyst take the course, they learn how to build it, and then we're all speaking the same language. So whether it's this or something else, I think what's important is that as an investor or a sponsor, you have to create a system to where you are looking at every project through the right lens. And that lens, to be able to scale that and bring out people on so everyone are talking from the same focal point, I think is very important. And that's what these underwriting models will do.
Have you ever used a meat thermometer to test, what temperature the meat is cooking at, right? There are lots of different variations of meat thermometers out there. There's the Bluetooth kind, there's the wired kind, there's the generic kind, there's the
infrared where you can
kind.
just do the surface of the meat.
You can do infrared, you can do probe. There's lots of different ones, right? If you go and check that meat, let's say you're cooking a brisket or a pork butt, and you use a different tool every time you go and check that temperature, you're going to get a different reading, right? Which means at the end of it, you're only hoping that you cooked it correctly instead of using the tools to gauge whether or not it's ready to be done, right? And so you've got to, and the res analysis is kind of like, it's that lens you're referring to. It helps us flow all of this information through one portal, and the portal will tell us, what it is without any bias. It doesn't explain. It's just red or green, right? Whether it's good or bad. So there's your analogy. There's your barbecue plug.
In every deal, there's certain metrics that you have to look at in order to make sense is it worth it going forward or not? Metrics such as on the business side, what is the EBITDA? that you're really working with. And we have, we're looking for 1 to 3 million in EBITDA, for example. So we've kind of set that stage of what businesses would fit. If something goes a little under or a little over, that's fine, but that's pretty much a framework to start with. But if you didn't even have the metric EBITDA to work with, how could you start making decisions? Whether it's EBITDA on a business or NOI, net operating income on an apartment complex, there's things such as DSCR, debt service coverage ratio, meaning of how much revenue you bring in, how many times can you afford making the financing payment. If it's a 1-to-1 ratio, you make all the money just to make the payment, and that's not a good thing. If it's you got a ratio of 2.0, it means you're making twice as much as what the payment would be. So and banks typically want to see 1.25, 1.3. But if you don't know what those metrics are and you can't model them and put them out, then it becomes very dangerous. Other ones are internal rate of returns or equity multiples. And that's just simply a multiple of what you put in. IRR is more of a function of what return does that look like over time, including all of, if you make more contributions or you receive more. And so understanding that, an IRR of 2-year return would be different than a 5-year return, but the multiple will be constant across the table, right? If it's a 3x multiple, whether it's 1 year or 5 years, it's still that 3x multiple. The point of having a good structure is to be able to take all of these metrics that are important and put them in a way that people can easily understand and take to make their own decisions. And that's why we do it.
And if you know who you're talking to, for example, people will ask all the time, how do you present to an investor? And the first thing I respond with is, do you know the investor? Like, do you know what they're looking for? Do you know what their appetite is? Do you know what their risk tolerance is? Do you know what their portfolio looks like? Because you could sit in front of a real estate investor and you could be pitching, hey, we're going to go buy a plumbing company. And he's looking for the real estate play the whole time, and you're 40 minutes into this awesome presentation. You're feeling like you're killing it at every level. Rate of return's amazing. Equity this, like infrastructure's there. And he goes, hey, thanks for your presentation. I'll let you know, because he's going to be polite, right? Or maybe she's like, I'll have to talk to my other people and we'll get back to you because they want to be polite. And in the end of the day, to your point, you didn't know what they were looking for. And if you don't know what they're looking for, you waste a lot of time and you miss your opportunity to pitch the right thing.
Yeah, and it goes for lenders, goes for partners, all of those. It's understanding what's important to them. The underwriting, you have all of the structure in place, right? But have you ever heard of garbage in, garbage out?
Yes.
If you have poor inputs or inputs that aren't grounded in reality, how in the world can you have an output that's even remotely close to reality, right? I think it's, first off, understanding that no pro forma, no underwriting model survives first contact with reality, period. The science to this art there's art and science to both of these things. You've got the numbers putting together, but it's how you're putting all of these inputs in. We talk about the excitement of the deal, and someone's so excited and they want to prove it, and they put these numbers in, and they're like, I'm so excited, but I'm going to use these numbers because it's conservative to my excitement. The reality is you have to use numbers that are grounded in reality, regardless of how excited you are about the project. And let me tell you a story of how that made an impact for us. We have a project. We're doing 320 apartment units and 116 homes in a multi-use project. I mean, it's a big project. The sponsors that we're bringing to the table, the developer and builder, they had a capital partner that the market started tightening up and they walked away right before closing. And they had it under contract at this point for 2 years. So they had been spending 2 years on it. They had put 1.2 million of their own money into it, and it was basically they were just going to have to write it off. Like, they just had a $1.2 million loss because they couldn't close. So in that sense, you think they were pretty excited about finding a new partner?
Jeez.
Very. So, but that excitement, if you carry over and you want to show all of these reasons why this is a really good project and why does it pencil when nothing else seems to? what ended up happening is this group that we approached that are now our JV partners, and that just means, in a joint venture, we're working together on the same project as partners. They get pitched, I don't know how many projects a day. And so we sent it to them. And what was interesting afterwards, when we were talking, I was talking to their financial or capital markets guy, and he said, you know, we see a lot of pro formas all the time. And the reason yours stood out is because it penciled, but all of your inputs were things that we know we could outperform on. What that meant to them is that we were truly being conservative to the reality of what people were experiencing right now, and it still penciled. And when you can show that, because when you show these massive returns, they're like, man, buy this Tupperware and all your dreams come true, right? It's what worked was taking an approach that said, look, we know we can do an incredible job on this, but we're going to illustrate it as though we don't, and it still pencils.
I had lunch with a lender a couple weeks ago, and I was asking, what information are you looking for so that when I send it to you, we're getting you what you want? And it was cryptic, and I didn't like his response, but it goes to this point. He said, your basic information, like give me financials, 3-year financials. I talked about the res analysis. I talked about a pro forma, and he said, send it to me. This will tell me how you guys analyze information. This will tell me what you're looking for and how you're projecting it into the future. So it's almost a test at the same time, right? You can check boxes all day long and say, hey, I gave you the information you wanted and it pencils. Why do you not like this? It might be because you don't have any financial savvy, or you haven't proven that your due diligence, and like you said, you gave them all of these metrics that they didn't necessarily ask for, but their response was, we love what you've put in here. This is great data, but respectfully, we're smarter than you are, and we're going to do better. So we're all in on this one, right? Because we know what we're getting into. So I think that half the equation is whether they like you and whether if you've got the pedigree to support what you're putting down.
I think there's an argument that can be placed. There's a difference between internal pro formas and external. You want to under promise and over deliver in every way. The external, it basically says, these are our targets. This is what we believe this project is going to do. If things go wrong, we've got these contingencies built in on all of this project. And so assuming that we expense out 100% of all of our contingencies, this is what we end up with, right? And that sets that expectation and that bar. And then internally, you're putting down and saying, look, these are the metrics we want to hit on a quarterly, annual, multi-year phase project. And what needs to happen in order for us to hit this out of the park? What do we really believe we can do if we hit the ground running and do it right? The expectations could go like this. If I tell an investor that they can make 30% on their money and I deliver 28, they're disappointed.
Which sucks, because that's a great return.
Right. It doesn't matter. It's a matter of how I set the expectation.
Exactly.
If I said we can get you a 19% return and I deliver a 28,
you're the hero.
They're thrilled. Right. So it's all about managing expectations. And that's a big part of underwriting. And it's not just showing what returns they can get or equity multiple. It's proving how you've thought about all of the inputs. It's also important to understand the markets you're in. And it's a little bit different than the business side. On the real estate side, we want boots on the ground. We want to understand the individual markets, the locations. Locations are extremely important on the real estate piece. So understanding the job market, and I think that's a major driver for fundamentals that have to be shown on understanding the information or inputs you're giving into the pro forma. What's the home inventory for building homes, the vacancy rates, how long are homes on the market? Healthy market, 6 months. I remember there was a time in the Boise Valley that the average inventory or the inventory was slotted for like 8 days. So it's not just about understanding the templates or the pro forma what you're using. It's taking all the metrics that matter to the investor or the lenders and putting that in a format that they can consume. And it's also understanding the inputs and putting reasonable or realistic rent growth projections, expense projections. You can't have a 10% rent growth and 0% expense growth. I mean, it's just
How? Yeah.
it's probably not realistic. And then you need to stress the model. When you're looking at businesses, think through this, how do you stress the model to determine if it really makes sense? On the real estate side, what we do is we'll say in this project, let's say we're projecting it to take 2 years. Well, what if it takes 4, right? We're projecting cells at an X amount. What if it's only 90% of those cells or 85? What does that do? What if the sales values, go up or go down? That all of those things are stressing the test. Another stress would be you've exhausted your contingency and there's another 10% cost on top of the 10% that you just, used up in your contingency. That would essentially be a 20% overrun on your project. At what point does this model completely break and things don't work? Underwriting for success is about pulling those pieces together in a way that gives you permission to go further into the due diligence process and make the acquisition of your dreams. That's what it comes down to.
On the business side, to answer your question, we'll stress test these, but there's some experience that comes with it, right? There's attrition when you buy a business. You're gonna have some fall off somewhere. It's just that, but I know it because we've been doing it. If I didn't own a company before, or if I had not purchased a company before, I wouldn't anticipate that. So my model isn't going to show it. So we'll stress the model by saying, what happens if there's a 10% attrition or a 20% attrition? If we lose 20% of the current revenue, what does that do to the bottom line? How does it affect our P&L? And where do those numbers change? Like if we're going to lose 20% revenue, how do we cut our costs and where do they get cut, right? And now you go back into serving people and serving communities and you don't want to cut jobs. So, you know, where am I going to reduce the water consumption and the electric bill? Anyway, so that's one way to stress test it. I think the other way to do it is there's lots and lots of data available to us to look at these industries before we even get into them. And they'll give you a projection of what does the industry outlook look like, which I think should be used. Those models can be implemented into your working models to say, okay, it claims that it's going to have a 7% increase over the next 5 years, but I'm projecting maybe a 10% decrease the first year, and then maybe there's an increase. And so you can just lay it out. Lenders are going to love to see that purview. Investors are going to love that you've considered all the options. You're not just the hype guy showing up and saying, we're going to kill it. You've proven all the way around. So I guess for me, if you're going to stress test something, you've also got to consider who's at the table with you or who's in your corner and what advisors can you consult with to make sure that you are really stress testing the right thing. Otherwise, you're still going to miss something along the way that could potentially bury you. One of the greatest lines, begin with the end in mind. I think that you can have all the excitement and energy even through underwriting a deal. And I've learned over the years that it's not just a group of a think tank guys or women sitting around a computer punching numbers. I enjoy it. I have a lot of fun testing and underwriting and proving concepts and stress testing, these models. And I think that when you begin with the end in mind that says the intention of this acquisition or the intention of this construction project or the investment in this vehicle, this is where I want to be in 5 years or 10 years or 1 year with it. And when you begin with that in mind and you start to work it backwards, specifically in the underwriting phase of it, right? If I want to be there in 5 years, how does this have to grow? I mean, if we're talking to investors and we're going to give them a 20% return on their money, what does that look like in 5 years? What does revenue have to be at, and what controls have to be in place so that we can produce a 28% return? That's stress testing your concepts. That's underwriting the project in a way where you can prove non-emotionally that it's actually real and possible and provide, the reasons as to why. So success, you got to believe it. You've got to be just relentless about it, but you can't be emotional about it. You got to prove it.
The other thing you can do, and I don't see this applied all the time, but you take those models that you've built to underwrite the project from the beginning, and you do it every quarter
Yeah.
on the project.
Yeah.
And what you do is you'll notice as things change, you might have more cost than expected on one side or the other, and then you'll start seeing how it starts changing with the reality setting in of what's actually happened, right? But what it does is it gives you the opportunity to make decisions as you're going to help protect the investor's interests. So for example, if that target you were talking about on the business, we want to deliver a 20% return, you go through on the business side and you do this exercise, every 3 or 6 months, and you start realizing, look, things are taking a lot longer. The return, now we're at 18%. Why is that? What's happened from our original assumptions? And what can we do now to rise above our circumstances and move in the direction of our goals, right? What can we do on individual pieces to either cut expenses, increase revenues, change a whole new product line, acquire a new company, to put this together so that it actually delivers far more than what we originally thought.
I was having a discussion the other day with my brother. He's in the IT space and he's wanting to go acquire companies. It was interesting to me to listen, how he analyzed those things and what he was doing. And I was like, this is the most exciting moment in a business venture. When things seem to be going wrong and they're tough, you dig in, you grab your bootstraps and you start to think things differently. You've obviously got a different perspective at that point, one that you tried to create when you were underwriting it, but now that you're living it and more importantly feeling it, you start to consider more options, and maybe there's a little bit of desperation coming out of you, and so you're kicking it into a higher gear, and new products are born, new systems are created, a new position might be invented with the purpose of increasing revenue or whatever the case is. And these moments, I wish people wouldn't shy away from them. They're good moments if you've got the right people around you to help rise above. You talk about rise out of the ashes. You're going to be better after you've gone through it the right way. So I enjoy them. I embrace them. I think they're great. Yes, scary. Yes, uncomfortable. No, you don't want them, but man, it'll be a defining moment.
My favorite books or authors, Brandon Sanderson, and in one of his fantasy novels, The Way or the Stormlight Archive, in the book, I think it's the second one, Dalinar, he's a general and he manages the armies of this people, and he's going up against an incredible force that's threatening to destroy their entire world and way of life. And he's trying to weigh his decisions and where to begin on how to defend from this monster, so to speak. He asks, what's the most important step someone can take? He says, is it the first one to go down that journey of taking responsibility and accountability, right? Or is it the last one, that when you finally accomplished your goal and finished what you set out to do? And he learned that it's neither. The most important step someone can take is the next one. And the thing about underwriting is it gives you permission to take steps, and it makes sense to go forward and take the next step on pursuing this, or the next step away from it.
Yeah, that's a deep dive into the common phrase, if the next step makes sense, we'll take it, and if it doesn't, we'll jump off. And that's really well said and exact words to live by. Not just in underwriting. You can underwrite your life too, like the choices that you're making with your family, with your spouse. I mean, I love it.
For all of you, our favorite listeners and participants, if you have any comments, please share them with us. We'd love to hear from you. Like, subscribe, share with your friends, and above all else, let's continue working together to achieve freedom of purpose. And in other words, let's be epic together.